Hi, this is Agility Footwear Company, Industry 1, Team I. My name is Whitney Smart, and my partners are Amber Hijazi and Taylor Brandstetter. Our strategic vision in Agility Footwear Company is to continually pursue shoe innovation and to empower consumers to push faster and farther with our innovative products. We want to offer a diverse selection of footwear to suit all of our consumers, no matter what stage of life. In the North America wholesale segment, year 11, our initial strategy was focused differentiation. We offered many different models with high quality and also asked for high price. It was a good strategy, but we lacked advertising, which resulted in a loss of market share. Even with a strong market and high demand in the industry, our lack of advertising cost us greatly, and our competitors quickly gained market share. In the North America wholesale segment, year 16, we changed our competitive strategy to best cost. We realized our original strategy was not working, and so we made changes. We continued to offer our consumers many different models and kept our quality high, but we dropped our prices significantly. We also increased our advertising budget. We began this change in year 14 and noticed an increase in our EPS, so we continued on. In the end, Team C was the industry winner. They had very high prices and offered low models from the beginning. They had a higher budget for advertising and branding with celebrity endorsements. At Team I, we kept our celebrity endorsement budget modest and retailer support to a minimum. At the end, we focused on low cost, offering high quality and many models, and higher budget for brand advertising, and we finished at fourth place.
Hello, my name is Amber Hijazi and I will be discussing our financial trends, starting with our net revenues trends. In years 11, 12, and 13, we had a very neutral focus. Our strategy was the same as other companies, which led to a decrease in market share. We initially invested high in private label, which was not a sustainable decision for us. Moving along to years 14, 15, and 16, we switched to a best cost strategy. We provided value and differentiation to our customers, which increased our market share, making it easier to sell shoes and turn a profit. We focused on the idea that you need to spend money to make money. With regards to our earnings per share trend, our EPS trended upward when we switched to a best cost strategy and focused on providing more financial resources to advertising and promotions. The increase in customer value and brand awareness led to an increase in market share and number of shoes sold. Once the new strategy was in place, this resulted in an increase in revenues and a climbing of our EPS. Lastly, I will discuss our stock price trend. In year 11, our EPS did not rise to the level of stockholders' expectations. Thus, we had a low stock price. In year 16, our EPS surpassed stockholders' expectations. Therefore, we had a higher stock price. With enough revenues in year 15, we could afford to pay back dividends to our stockholders, which helped increase our stock price as our shareholders witnessed Agility Footwear Co. profiting. Now I will turn the rest of the presentation over to our other co-manager, Taylor.
Hi, I'm Taylor Brandstetter, and I'll be covering the competitor analysis. Team I's biggest competitor throughout the simulation was Team F. They definitely held the largest market share in our area of high models, high quality, high price. We were unable to get past Team F throughout the simulation just because I think they started off with some stronger strategies in the beginning than what we did. We were forced to lower our price to be able to differentiate from Team F and eventually get our own good size market share and move up in the BSG simulation ranks. Strategy differences that I think Team F had that was kind of where Team I fell short was that they had slightly higher retail prices in all regions from the get-go. So Team I kind of started off a little low in the retail price and then caught on to we need to increase our pricing, increase so we can make some more revenues and be able to get revenue for the quality that we're providing customers and to be able to sustain higher models and higher quality. We started that kind of late while Team F came out strong out of the gate and was charging a higher price, and was then able to kind of bring that price down a little bit, but still can maintained a high price for their product. So we kind of started late with that. They offered more consumer rewards, this being melon rebates. We didn't offer melon rebates to all of our consumers like Team F did, and they offered higher melon rebates and also free shipping. We didn't offer free shipping to all of our regions like Team F did. I think these couple of things, they started these again out early and were able to gain a lot more consumers than what we were able to, and it seemed to cost us more to then be able to incorporate these type of rewards later on. So that was the biggest thing, is that we started kind of late with that. And so being able to incorporate these kind of rewards actually cost us more and increased our production costs, and sometimes would only help us a little bit and cost a lot more. So we decided not always to move forward with those in certain regions. Slightly higher quality in certain regions. Team F definitely kept higher quality than us in some areas, and that was something that we decided to move down a little bit with the higher price, higher models, and higher quality, because Team F had already had such a high price with a high quality. We decided to kind of keep our quality slightly lower and that way we can kind of afford that little bit of a lower price. That way we can kind of move away from Team F, but they definitely had higher quality, again, coming out of the gate, striving for that and making sure that they had the quality to match their price. They also, again, started off early with advertising. Team I, we did not start off with advertising very strong. We came in with a very low budget, didn't get any celebrity endorsements. And so it was probably about year 13 that we were able to finally get a celebrity endorsement, and then realize that we need to be spending a lot more financial resources in advertising and brand advertising. So Team F definitely came out strong with that. They were investing a lot very early on, in which that enabled them to then reduce the amount of resources that they're having to put towards advertising later on, because they had already built their brand. They already had loyal customers. Um, they already had brand awareness. So later on, come year 15, 16, they were able to reduce that budget spent there, because they had already, gained a very large consumer base. So in that, they had celebrity endorsements, and they weren't needing to um, invest so much there like we were, because we had to catch up, essentially. So that was a higher brand reputation for Team F. They definitely were striving in that area where we kind of lacked and didn't catch on to until about the year 13 or 14. They also did not waste any resources in private label. Unlike our team, Team I, one year decided to try to control the private label market and maybe delve more of our resources into that area, and control and work in the private label instead of so much in branded production. We later found out that was not the right move, and we needed to move all of our resources back to branded production. Team F, on the other hand, never invested in private labels, so they never wasted resources there. And even by year 16, they still had zero investment in private label, while we still had some remaining. But we did learn to reduce our private label as well, but that definitely put Team F ahead, because they were able to allocate all of their resources to branded production. Had a few more years with the BSG simulation, we definitely think that we could have surpassed Team F. I think we were on a very good roll on our decisions at this point. Some of the things that we would have continued to do was the best cost strategy. We've really found that that was working for us, increasing our internet and wholesale marketing for branded production, and really focusing there, and the strategy that we kind of had going for that best cost mindset. We would decrease the selling of shoes and private label. So by the end of year 16, we did still have some investment in private label, but as we could tell from Team F, private label was not where to be, and we needed to remove the rest of our resources from those areas. Definitely what we've learned is increasing advertising in wholesale markets. With a few more years to go, we would still have to invest heavily in advertising, but that seemed to really set us apart and start increasing our market share. So we would strive to continue investing in the celebrity endorsements and marketing and being able to increase our retail prices at that point and be able to gain more of that market share because we'd be getting a better consumer base. And then eventually we'd be able to reduce those investments into those areas once our brand is stable and well known and we have a good, strong brand reputation. Lastly, we would increase our quality as revenues increase, but what we would do is we would definitely use the BSG simulations tools more effectively. We did seem to kind of navigate away from using those tools and the calculations that the BSG simulation provided when we would do things that would slightly change the operations costs. What we did learn is that any small figure that you change could change your operations costs drastically, and it won't benefit you at all, or a small change could benefit you a lot and not to change your production costs very much. So we kind of caught on to that a little bit late, but definitely now that we know, we would go in strong in the next few years and really be able to utilize lower production costs, higher quality, and a best cost strategy. At the end of the BSG simulation, there were quite a few lessons learned by our team. A lot of them customer based and a lot of them strategy based. What we did learn after the first 2 years in the BSG simulation is that the customer is first. Managers should always put the customer first. What we really focused on beginning this simulation was our revenues, our ROE, what our EPS looked like, things like that, instead of focusing on providing rewards like mail-in rebates or free shipping, spending more in advertising and a price that matched our quality. We didn't really utilize those tools to build customer satisfaction, and in turn, customer satisfaction increases our revenues. And so we learned this over the year 11 and year 12, and then started investing more in corporate citizenship and our customers and what they want to see and things like that. And then our revenues were going up quickly. And so that is a note to all managers: is managers should focus on what the customers value. Managers should not copy the competition strategy. In the BSC simulation, we didn't copy strategy, but what we did is we started off very neutral. We kind of looked at what the other companies were doing, and we went ahead and kept a very neutral strategy, meaning that we kind of went high model, high price, higher quality, but we didn't go strong with that. We just kind of maybe kept an average amount of models, an average amount of price, or average price level. That was on the higher end, but wasn't high enough to make a difference. So the next 2 points on that slide, it's managers should carve out their strategy, and they should use that strategy, that differentiation strategy, and started it early on. What we didn't do is we didn't start with a strong strategy early on. What we did was we started very neutral, and then we had to catch up later on because our strategy wasn't very strong starting off. A manager should always find a strong strategy, and differentiate and push that strategy to find the area of the market where they can strive best in and get away from their competitors and be able to gain market share early on. Managers should implement practices that increase stakeholder value. That is very important. We weren't able to give any shares of stock till the very end of the game, which probably would have helped us a lot more if we were able to do that early on, which that all kind of goes back to investing in our customers, having a stronger strategy. If we were able to implement those things early on, we would have been able to provide that to our stakeholders. Managers should determine industry price points early on. The BSG simulation, higher price was key. In a lot of cases, the winners of this game, they did have higher prices. But managers should, whatever price point they're going to aim for, whether it's low price or whether it's higher price, they must decide that strategy early on. Otherwise, you get too far behind in the game, especially in the BSG simulation. You get too far behind, and then you can't increase your price without increasing your quality and then your production costs, et cetera, et cetera. So determining that goes along with your early differentiation strategy and applying those tactics early on. Closely monitoring operations cost amongst each decision to determine which cost provides the most value to the customer and company. Team I, we learned our lesson over the course of the game is that we weren't really closely monitoring our operations costs. We couldn't figure out why changing something by 50 cents made our revenues go way down or way up. And it was really because we didn't utilize fully until later on the BSG simulations tools of calculating certain operations costs and trying out different numbers to figure out what would increase our projected income revenue, our EPS, our ROE. So definitely applying more operation cost effective management skills that would first benefit the customer by keeping quality high, which results in us being able to keep quality high, but also cutting costs that we wouldn't have to generally spend. So those are our lessons learned.